It was a day like no other, a day that would change Wall Street forever. October 19th, 1987, a day that came to be known as Black Monday. Billions of dollars vanished into thin air, leaving investors in shock and the world asking, how did this happen? Let's journey back to uncover the rise, the fall, and the chaos that shook the financial world. The 1980s were a golden era for Wall Street. The U.S. economy was booming, fueled by deregulation, globalization, and corporate greed. Investment firms thrived as people flocked to the stock market, believing it was the quickest path to wealth. By 1986, the Dow Jones Industrial Average had crossed the 2,000-point mark for the first time. It was a symbol of hope and progress. But behind the glittering facade of prosperity, cracks were forming in the foundation. Deregulation encouraged risky behavior. Companies borrowed heavily to fund expansions, and the stock market grew increasingly dependent on speculative investments. It was a high-stakes game, and the players were betting big. As technology evolved, Wall Street embraced computers. Program trading, a new form of automated stock trading, emerged. This allowed traders to execute large-scale transactions in seconds, something that had been impossible before. Program trading was praised as a revolutionary tool. It allowed firms to hedge risks and make trades more efficiently. But this new technology came with a dangerous flaw. It operated without emotion or restraint. Many didn't realize it at the time, but program trading would become a key player in the chaos of Black Monday. It was a double-edged sword, efficient but ruthless when things went wrong. In early 1987, the mood on Wall Street was jubilant. The market continued to rise, fueled by optimism and confidence. Investors poured their money into stocks, believing the good times would never end. But beneath the surface, there were warning signs. The U.S. trade deficit was ballooning, interest rates were rising, and geopolitical tensions, including a strained relationship with Japan, added to the unease. Despite these signs, most ignored the risks. Everyone wanted to ride the wave of success, and few stopped to question where it might lead. By October 1987, cracks in the market were starting to show. In the weeks leading up to Black Monday, stock prices began to wobble. The Dow Jones experienced several sharp drops, creating an air of uncertainty. On Friday, October 16th, the market dropped over 100 points. This was the largest single-day drop in its history at the time. Over the weekend, investors braced themselves, not realizing the worst was yet to come. The weekend brought speculation and fear. Rumors of a global market collapse spread like wildfire. By the time the markets opened on Monday morning, panic had set in. The day began like any other, but it quickly turned into a nightmare. The Dow Jones opened sharply lower, and within minutes, the selling frenzy began. Stocks plummeted, and panic swept across the trading floor. Computerized program trading kicked in, amplifying the chaos. As prices fell, the programs automatically sold off more shares, creating a vicious cycle. The market was in freefall. By mid-morning, it was clear this was no ordinary day. Traders were frantic, investors were panicking, and the market was in chaos. The question on everyone's mind, how far would it fall? The shockwaves of Black Monday weren't confined to the United States. Markets around the world began to collapse. In Tokyo, the Nikkei index fell 15%. In London, the FTSE dropped 10%. The panic was global. Investors around the world watched helplessly as their portfolios shrank. It was a financial contagion like no other, proof that in a global economy, no market is truly isolated. Governments and central banks scrambled to respond, but the speed of the collapse left little time for action. The damage was already done. For some, Black Monday was more than a financial disaster. It was a personal tragedy. Many lost their life savings in a single day. Pension funds were wiped out, and small businesses collapsed. Stories emerged of devastated investors who couldn't bear the loss. Some even took their own lives, unable to face the future after the crash. Black Monday wasn't just about numbers. It was about people, and the human toll was immeasurable. In the days following Black Monday, the Federal Reserve took decisive action. Under Chairman Alan Greenspan, they pumped liquidity into the system to stabilize the market and prevent a full-scale financial collapse. The recovery was slow but steady. By the end of the year, the market had regained much of its losses. But the scars of Black Monday would linger for years. It was a wake-up call for regulators, investors, and policymakers. The crash exposed vulnerabilities in the system and highlighted the dangers of unchecked speculation and technology-driven trading. Today, the financial world is more interconnected than ever. Advances in technology have made markets faster and more efficient, but they've also introduced new risks. While safeguards like circuit breakers and trading halts have been implemented, questions remain. Are we better prepared, or are we simply waiting for the next Black Monday? The lessons of 1987 are clear. Complacency and overconfidence can lead to disaster. The question is, will we remember them? Black Monday wasn't just a crash. It was a moment that defined an era. It was a reminder of how fragile our financial systems can be and how quickly fortunes can change. As we move forward, the shadow of 1987 still looms over us. The question is, what will we do to prevent it from happening again? The cracks in the foundation started subtly. Rising interest rates became a major concern for investors, as higher rates meant borrowing became more expensive. For corporations that had taken on massive debt to fuel growth, this was a warning sign. By mid-1987, inflationary fears and a growing U.S. trade deficit further dampened investor confidence. Economists warned of instability, but few paid attention. The stock market had been on an unstoppable climb. Why would it stop now? But as history would show, when optimism blinds foresight, disaster isn't far behind. The warning signs were clear, but most refused to see the storm brewing. On Friday, October 16th, the first domino fell. The Dow Jones dropped over 108 points, equivalent to about 4.6% of the market's value. It was the largest single-day drop in history at the time, and it sent shockwaves through the financial community. Investors began to panic, and the weekend became a frenzy of speculation. Some believed the market would recover on Monday. Others feared the worst, pulling their money out in a preemptive move. The seeds of chaos had been sown. The world watched as Wall Street prepared for what would become the most catastrophic day in stock market history. When the markets opened on Monday, October 19th, it was clear this was no ordinary day. Panic had gripped the financial world. Orders to sell flooded the system, overwhelming the market and causing prices to drop at unprecedented speeds. Program trading, designed to protect investors, became the market's worst enemy. These automated systems triggered massive sell-offs, compounding the crash. Stock prices nosedived, and the downward spiral seemed unstoppable. As the morning wore on, the markets around the globe joined the freefall. In New York, London, Tokyo, and beyond, it was a financial bloodbath. The world had never seen anything like it. Black Monday wasn't just an American crisis. It was a global phenomenon. In Tokyo, the Nikkei index plunged 15%. In London, the FTSE dropped 10%. Panic spread across Europe and Asia as markets mirrored the collapse in the US. The interconnectedness of global economies meant no market was immune. Investors worldwide rushed to sell, exacerbating the chaos. It was financial contagion on an unprecedented scale. Even nations with seemingly stable economies found themselves caught in the ripple effect. It became clear, in a global market, no one is truly safe from a collapse of this magnitude. Behind the numbers and statistics were real people. Retirees saw their pensions vanish overnight. Small business owners who had invested their savings were left bankrupt. Some traders who couldn't handle the stress of the collapse made tragic decisions. One broker described it as the longest day of my life. He watched as years of work disappeared in hours. For others, the devastation wasn't just financial, it was deeply personal. Black Monday wasn't just about Wall Street, it was about people and the fragile dreams they had built on the promise of a rising market. By the evening of October 19th, it was clear the market couldn't stabilize itself. Enter the Federal Reserve, led by newly appointed Chairman Alan Greenspan. His quick action would prove pivotal in preventing a complete economic meltdown. The Fed flooded the system with liquidity, ensuring banks had enough cash to operate. They made it clear they were ready to provide whatever support was necessary to restore confidence. Greenspan's intervention calmed the panic, but it was only a temporary fix. The crash had exposed deep flaws in the financial system, flaws that regulators and policymakers would need to address in the years to come. In the aftermath of Black Monday, the financial world took a hard look at itself. Regulators introduced measures like circuit breakers to prevent rapid sell-offs and trading halts to curb panic during volatile sessions. Program trading came under intense scrutiny, with many blaming it for amplifying the crash. While it wasn't the sole cause, it became a scapegoat for the financial community's collective failure to foresee the risks. The lessons of Black Monday were clear. The system needed safeguards, and investors needed to be reminded that no market rises forever. But as time passed, many wondered, were the lessons truly learned, or was history doomed to repeat itself? Today, Black Monday remains a stark reminder of how quickly fortunes can change. It was a day that exposed the fragility of our financial systems and the dangers of unchecked optimism and innovation. While safeguards have been implemented, the rise of high-frequency trading and global interconnectivity has introduced new vulnerabilities. Economists warn that another Black Monday could be just one bad day away. The story of Black Monday is more than a financial tale. It's a cautionary reminder of our collective responsibility to build systems that are resilient, transparent, and prepared for the worst. October 19th, 1987, a day when the unthinkable happened. A day that changed the way we view the markets and reminded us of the unpredictable nature of our financial world. As we move forward, let's remember, history doesn't just repeat itself, it often rhymes. The question is, will we listen to the echoes? If you found this journey as fascinating as I did, be sure to like and subscribe for more thrilling tales that ignite your imagination. Thank you for joining us, and remember, the best adventures are just a click away.